Are you wondering why so many quality dividend stocks like PepsiCo, Coca-Cola, and Hershey have all been dropping over the past year, and which one might be the most solid investment right now? What's up? I'm Russ. I'm a blue-collar welder that's passionate about passive income and blue chip dividend stocks. So we crunched some numbers using data supplied by Simply Safe Dividends and looked at 14 consumer staple dividend stocks with a snack food tilt to find out which one was performing the best when comparing their trailing 12-month numbers to their 10-year baseline average. And we found a clear-cut winner. I know, I honestly don't believe that diabetic drugs like Ozempic or Wegovy are going to collapse the fast and or snack food industries. I mean, healthy trends like CrossFit and plant-based vegan diets may have dented snack food revenue, but as we say around here, like all living, breathing things, these businesses will do what they have to do to survive and adapt to meet consumer demand. Plus, a fraction of the world's population is going to be using these drugs, but they are far from a miracle panacea, which is a fancy way of saying cure-all. Look at you getting smarter, you smarty smart. And like Cher said, fitness, if it came in a bottle, everybody would have a great body. I think the same thing applies here, and a new report found that 2 out of 3 people on drugs like Ozempic stop within a year. So until human behavior changes, I think these fast and snack food businesses will be just fine, and I would love to know in the comments below what you think. And it looks like what's driving down these stock prices is good old-fashioned competition from investors who are only concerned with getting as much yield as possible without risk to their underlying principle are selling stocks. Because any stock is risky, and buying a treasury means that people are going to be getting a risk-free return on their money. So check this out. In mid-July 2023, the 10-year treasury yield really started taking off, and it was a little bit later in July of 2023 that the consumer staples ETF XLP started dropping in price. So I think this brings us to falling blue chip stock prices and a fantastic buying opportunity. So the bottom is likely going to be when the Fed starts cutting interest rates, but as of right now, nobody knows what's going to happen. So for those of us that love to buy quality companies, sit on our hands and do nothing. Falling prices are just plain awesome. Hey, look at me getting smaller. Hey, check out this spreadsheet I made just for you. Yes, just for you. This is the consumer packaged goods spreadsheet. A little bit about how it works. It looks like a lot of data. Told you we crunched a lot of numbers on these 14 stocks. The very first thing at the top you'll see is the ticker symbol. If you click on that, it's going to take you to seekingalpha.com where, hey, this is the premium account, and yeah, there's a lot of stuff and interesting things on here, but if you have no account or incognito, you can still get good information. But if you would like to try the premium for a world of information to help you be a better investor, I do have an affiliate link in the description below, and you can get a nice little discount for yourself. And then right below it are these cute little emojis where we have the brands. If you're not familiar with these, like maybe you're not familiar with J&J Snack Foods, you will see that they have brands such as Super Pretzel, Icy, and Dippin' Dots, not to mention Hola Churros. And then as we talked about, the XLP, the consumer staple ETF, link it'll take you to the Seeking Alpha summary page. Check it out. It has currently 39 stock holdings in it and a 0.10% expense ratio, meaning you're going to pay 10 cents for every $100 invested every year. So all the ones with the green check mark are currently included inside of the XLP ETF, and the only few that are not. So buying it in one shot, you don't want to mess around with individual stocks. The ETF certainly is the easy button. Now again, all these numbers were pulled from Simply Safe Dividends, and if you're a numbers nerd, feel free, check it out, have at it with the link in the description below. And the way I did it, the red means it is a negative compared to the 10-year baseline, except for the current dividend yield and the forward PE. Those are 5-year averages, but everything else is a 10-year average. So for instance, for PepsiCo, their current free cash flow per share of $5.05 is 7% above the 10-year average, so it gets a green tick. But if you're Tootsie Roll and you've got 60 cents of free cash per share, you get a red tick red box because it is 33% below the 10-year average. Yes, this tells us nothing about what's going to happen in the future, but it is a nice indicator of where things are at with those stocks compared to their 10-year baseline averages. So if you are that data nerd, have at it. But for the rest of you that just want the quick and dirty answer, well, there it is. In the number one spot, it is Coca-Cola, which had an 11. I did this kind of hockey style plus minus rating, so it was a plus 11. And with 8 in the second spot was Mondelez. And surprisingly, Kraft Heinz was number 3. Not a really good dividend growth stock, not one that I would invest in outright. But if you do invest in the ETF, the XLP ETF, you get exposure to 39 great consumer staple dividend stocks, including the ones on here with the green check mark. Right in the middle is number 7, PepsiCo, and at the very, very end, might want to be careful, Keurig Dr. Pepper, ticker KDP, was rounding out the number 14 spot. We'll take a quick run through look at Coca-Cola on the aforementioned Simply Safe Dividend. Feel free to pause the video if you want to look at these numbers and trends a little bit more in depth, but they do get a dividend safety score of 80, which is safe. Now, during the last recession in 2007 to 2009, they had negative 4.8% recession sales, and their overall return was negative 31%, but the S&P 500 was negative 55%. Doesn't really matter much to me if you're a long-term buy and hold investor because things obviously rebounded nicely. Fantastic dividend growth, 60 years of increasing that dividend, and 103 years of uninterrupted dividends for Coca-Cola. They're going to go ex-dividend November 30th. If you didn't know, you need to hold shares of Coca-Cola at market open on November 30th to qualify for that dividend that's going to be paid on December 15th. Just to be safe, my rule of thumb would be to make sure you own the stock the day before on November 30th, and you'll be fine for that next dividend payment, which it looks like they will be raising early next year, probably 2 cents. That's been the near and short-term historical trend. Once again, that dividend yield of 3.37% is 10% above the 5-year average. And that forward PE of 20.2, remember the easy way to think about this is you're paying $20.20 for every $1 of Coca-Cola's earnings. So that's the way we figured it out. The trailing 12-month or the last 12-month number of 82% for the free cash flow payout ratio. I like this number much better than earnings per share because the EPS number can be manipulated by things like share buybacks and whatnot. But the free cash flow is much harder to manipulate or financially engineer. So a current 82% free cash flow payout ratio, little bit higher than we like to see it, but I took the 10 years of numbers, got the 10-year average, and that's what we compared to being a percent above or below for the free cash flow payout ratio. Free cash flow per share, $2.19 can cover that dividend, and it's supposed to be $2.32 next year, they're predicting. And isn't that crazy? Look at all the negative sales growth that this blue chip stalwart had from 2013 to 2020. They don't really do a whole lot of share buybacks, and in fact, they've increased their share count since 2018 to 4.34 billion shares. Had a bit of a rough patch there with those negative sales and whatnot in the late teens and early 20s. Return on equity 40%, but remember, ROE can be skewed by debt. Return on invested capital just really nice in the mid to high teens of 17% for Coca-Cola. And again, operating margin, thinking about that is what is left over after deducting the cost of the goods sold and what it takes to run the business, 29%. Free cash flow margin, 22%. That means out of every $1 in revenue or sales that's coming into Coca-Cola, 22 cents is making it to free cash flow, meaning that you can do a few things with the free cash flow. You can pay a dividend, you can buy back shares, you can pay down debt, invest in the business, or carry it as cash on the balance sheet. Net debt to capital and EBITDA, these are both coming down and lower than the 10-year average, so they get a green check on the spreadsheet. And this was the only negative. This was the only thing that got a red mark for Coca-Cola, and it's not even that bad, is the interest coverage ratio of 10.11, meaning that they have $10.11 of operating income to pay for every $1 of interest expense, so they can easily cover the interest on their debt right now. But it is substantially below the 10-year average. So I had to give it the one red check, but honestly, that is just really, really fantastic, and I don't see anything to worry about at all. But while Coca-Cola looks great, check this one out. Tootsie Roll. They have no net debt, and they currently have $968.60 to cover every $1 of interest expense on their debt. Way to go, Tootsie Roll! I'd love to know what consumer staple stock that might have a snack food tilt you are buying. Please share it with the community below. Don't forget, I have a free weekly newsletter you can sign up for at DapperDividends.com, link below. And if you would like to learn about some really interesting stocks not a lot of people talk about, and not fearing the reaper but profiting instead, click this video right here next to my head in this little box, and if you do that, I will talk to you there.